All right, before we continue, we're just going to walk through some very general rules of trading pivots. And the reason I say general rules is because we are going to have some rules trading pivots, but they're of course going to be combined with all of the rules trading some of our other some of our other tools or employing some of our other tools as well. And there are always rules to be applied in the market, and we have to be flexible with those rules. But there are some rules that we have to be absolutely strict with, and those are more particularly pertaining to our equity management and our management of positions. First of all, it's important that as price and price action and the market trades within a specific range in the day, it is higher probability if we buy below the central pivot. So below the central pivot is the buy zone. Above the central pivot is typically an area where we look to be selling, and only really buy if price has moved from the sell zone into the buy zone. You only really want to buy above the central pivot or sell below the central pivot when the market direction has been pushed really convincingly by a chart pattern or some very distinct characteristic or news event, something that has just really created an absolutely convincing one-sided flow to the market. And if a trade presents itself as a buy in the sell zone or a sell in the buy zone, then it's possible to do so. However, keep in mind that probability is still in all likelihood working against you. Pivots are really, again, just a way in which we want to map out what is happening on a daily level or on an intraday level primarily, and we are using pivots as our reference points for the moderate range within which a currency pair will move for a session, and that's why we aim to buy in the appropriate zone, buy or sell in the appropriate zone, because once again we want to be entering the market in the higher probability regions of the intraday price action. As well, we want to use it to establish our protective stops and our limits for profit. Keep in mind that pivot levels are what we call invisible levels of support and resistance. So take profit ahead of these levels where the market may bounce or reverse. And we have to leave enough room though to account for the spread for our stops and our limits ahead of the major levels of support and resistance. Just to show you, give you a little bit more visual perspective, if we have our central pivot on a chart for the day, anywhere in the area below the central pivot is the buy zone. Anywhere above the central pivot is typically a sell zone. And we'll make more sense of this as we move forward. Say, for example, price moves into a current trading day. Let's say that this green line is 0-100 hours GMT, and we move into the new trading day, and price moves down into the buy zone. Then we want to look for distinguishing characteristics here in the buy zone. We want to look for distinct levels of support along with our visual levels of support in history, trend lines, Fibonacci, use of our indicators, and so forth, to look for a low to be established and an opportunity to buy with the anticipation that the range may move from the sell zone up towards the central pivot and potentially into the buy zone. So if we have a confirmation here, or based on some of the techniques that we're going to learn and apply, we will look to buy in the buy zone with the anticipation that price will move up, but we want to take our profit before some of these key levels in the event that price may bounce at these levels and move in the opposite direction. Looking at this from a more visual perspective with a chart in front of us, If price enters the market in the buy zone, here we watch price as the session opens up. This is GMT, 4 a.m., 5, 6, 7, 8 a.m. Central European markets get busy and London gets busy. And here we see price achieve a low. And we, of course, will apply a number of our tools to look for a trading opportunity. And we want to take some profit potentially before the central pivot or before other key levels that the market is approaching, because we may see a reversal at any one of these levels. I've simply noted some of the points where we want to take profit. Since the market can and will and may turn at any one of these technical points as it chooses. Price enters into the new day in the sell zone. We sell here on confirmation, looking for price to move to at least the central pivot or even lower. Price enters in the sell zone. As London and Central Europe trading opens, we retrace to M3 and price reverses at M3. You see how it traded in this range for approximately 1 hour and then reverses through the central pivot all the way down to S1. Now I know I'm just walking through some basic techniques at the moment, and you want to know how to enter a trade and when the best opportunity is to enter a trade. I'm just kind of showing you some price patterns here, and we're going to get into that once we get into some simulated trading scenarios at the conclusion of seeing some of these still shots. Because this is all good in theory after the fact, but again we'll see more simulated scenarios. Just want to show you a nice market characteristic here, how price found support at the central pivot, rallied, turned at M3. As it broke through the central pivot, it came back and tested the backside of support, now resistance. Price came down to M2, tested the backside of M2, and then continued down and consolidated through the close of the session. Again, pivot levels are invisible levels of support and resistance that we have to map out on our charts at the beginning of each trading session. A level of support that is penetrated by the market becomes resistance to the market in the future, and that applies to these invisible levels as well, as defined by our pivot points. A level of resistance that is penetrated by the market becomes support to the market in the future. And that's a point that you will see me drive home time and time again, as long as you're listening to these CDs and watching the simulated scenarios and belong to the Pro Traders Club. Those reviews will continue to reinforce that point to eternity. Again, each pivot level represents a level of resistance, and as price moves through the level of resistance, we will often see it act as support as well. Central pivot, resistance. If price moves through, it can offer support. M3, resistance. As price moves through, it can offer support. Here price moves into the sell zone, enters the trading day in the sell zone, bounces twice to the central pivot. Even here alone, there was, even if you bought here at the central pivot, which you could do, price rallied up more than 30 pips before hitting M3 and turning down, and again testing the backside through M2, testing the backside, and moving through to the close of the day. Support becomes resistance, and so forth. Another fine example of support. Price moves to M3, down to S1, down to M2, and price rallies. Support becomes resistance. What's important to look at here, folks, is you see even the distance between resistance and M2, central pivot and M2, there's still a very tradable range that you can profit from. And when we look at our finding our ideal entries, we're going to see this more closely as to how you can capitalize on these scenarios. Price bounces off the central pivot and continues lower into the next trading day. This chart is simply just a graphic to show you how price acts as both resistance and support. We see here our pivot levels, and we see how the ranges trade between the resistance and support, the levels, the invisible levels of resistance and support. Okay, really fit in here quite nicely as price trades between our key levels. Each of these pivot lines represents a level of resistance and support, and we see how price ranged on this 15-minute chart between those levels as it continued to rally, and traders generated new levels with the flows. Well, show me when to make a trade. We will do that during some of our simulated scenarios that are specific to pivot points, but we will see it even more clearly as we merge our study of pivot points and our practical information of pivot points with all of the other tools that we use for our discretionary trading. You look to make a trade in the buy or sell zone, buying in the buy zone, selling in the sell zone. The market typically gets more liquid or busier at 7 to 9 a.m. GMT. That's when liquidity picks up and offers the more ideal opportunities for trading. Be very conscientious of market volatility and liquidity, and you have to factor this into your trading decisions, because as efficiency and liquidity picks up in the market, then what happens is when the larger traders, when the bank traders come to work, they've got their order book, and they have to fulfill demands from their order book, and demands from clients that not only are that have been pre-established, but also ones that are flowing in that given day for whatever specific reason. And when these traders are at work during the Asian and London session, it's important that you know that the volume and liquidity is heavy at that time, and often our technical factors offer the most profound trading opportunities at that time. Again, we are not going to trade pivots in isolation. In fact, we're going to look for a convergence of factors using pivot points, fibs, support, resistance levels, indicators, and clearly defined key levels with the use of combining all these factors in order to look for high probability entries. Here we see price move in the sell zone, and we see that traders take price up early in the session, testing the previous day's high, which is also R1, which is R1 of the previous day. Now M3 on the current day, and price falls. We see a double top at M3 holding. Then what you can do is you can draw a trend line on this short-term chart, and the break of the trend line can confirm a move down, and you may want to take some profit before the central pivot. If not, you can take some profit before the central pivot, or you can let it continue if you like, because price could simply bounce to the central pivot and continue up. But here in this case, it moves all the way down to S1. But be sure to exit your positions before the key levels, as we may see it a turn at that point. Here's an example where price enters in the buy zone and it retraces down beyond S1, and we see this consolidation. Here we are applying the Tom DeMark trend lines as we see price visually break down. Price failed to, we'd have to know where this reference point is relative to what's happened in the past, and we watch price penetrate through the Tom DeMark trend lines in 3 stages before making a decisive move up. And if you enter on either one of these breaks, then be sure to take your profit before key levels, particularly before the central pivot point, if possible, or any point beyond that. What I'm saying is that you could take 50% of your, 50, 60, 70, or 80% of your position out at the central pivot, and you can leave some in the event that price continues to rally another 30, 50, or 100 pips for the day or for the next several days. This is an interesting one. We see an established day's low here at S1, and then price rallies. This is a nice deep rally, and then it makes another attempt at these lows, which is very interesting because to retrace this much and then to move all the way down and for price to actually actively hold below this level is less likely because there's typically only a given number of flows that will move into the market in a day, and the more activity that we see, the more volatility that we see within the intraday range without establishing new highs or lows, then what will happen is that liquidity will start to fade, and as liquidity fades, price is typically less likely to move and hold below an intraday established low. Here we see a nice hammer and a double bottom at S1 before price begins to rally. Now, if you're not comfortable with trading down here, you can wait for the break through the trend line, and but of course your stop will be bigger. And be sure to calculate and place your profit levels before the central pivot or other key levels that have been established above your entry. Price on this occasion moves into the market in the sell zone, and here what we had was we had a consolidation at the central pivot waiting for the market to waiting for Eurozone to come out with an economic report, and when the report came out it spiked right down to M2, first level of support, and then came back, tested resistance, and then continued to move down. Price opens in the sell zone, retraces to R1, and we're just showing a very simple example of how to apply your Tom DeMark trend lines, and looking at Tom DeMark trend line in this case, this is more of a common sense trend line, and seeing how price can break down, and as price breaks down you can sell, but with each breakdown you're getting further and further away from your stop, and that brings in more risk on the trade, because if you had traded it up here, the break up here, or had traded this high for some reason, then obviously your stop's going to be closer. But the further price gets away from you, the more vulnerable you are, the more subject you are to price pulling back, threatening your stop, or stopping you out before continuing down. And I like to have my entries as close to the high as possible, and the more it pulls away, the more uncomfortable I get. Another classic case here where we had the previous day's low and price comes down and tests the low, starts to make a move upward, and then comes all the way down and tests it again and fails real nicely. Once it failed, we see a conversion. The sellers, effectively the sellers, had no strength whatsoever to move price below these key levels and hold and continue trading. And as the sellers begin to fade, what I'll do is I'll watch these candlesticks very closely, and these are 15-minute candlesticks. So price probably moved very quickly down through this level of support. And I'm trying to remember this event specifically. I believe it was event driven, and and if we see a real fast move below these lows and price come retreat and there's no follow through in the selling, then we will often see a significant conversion into buying, or just the lightening of liquidity of the sellers will generate a big move in the opposite direction. And we see here how it bounces off of its technical parameters before continuing up. Just want to show you here what a 60-minute chart will look like. These bold red lines are the central pivot, and the green lines are support and resistance. We do not have the midpoints built in here. We know where the midpoints are. They're in between the pivots and the support and resistance, right? So I just want to show you how price moves here in relation to the central pivot. Here we enter in the sells in the buy zone, and there are buying opportunities. Here we enter, price enters into the market in the sell zone, and there's selling opportunity. Now we're in the sell zone. There is buying opportunity and a move up. Price enters in the sell zone and price moves down, complemented by a hammer. Price enters into the, actually what happens here is we have this move down, and this consolidation is non-farm payrolls, and it spiked up to the central pivot, which was also on this particular occasion was a 38% retracement, and it was also this level of support, which is resistance. And these are the kind of combination of factors that we're looking at when we're going to make trades. When the non-farm payrolls event came out, price spiked up, and it retreated and was weak, and then it simply made a decision to go in the complete opposite direction. It was really quite a wonderful day for trading. Again, here we open in the buy zone, complemented by some nice candlestick formations, a nice hammer and a railroad track. Price proceeds up, and we want to take our profits before the resistance levels. Looking at the previous day's high, price moves up in an attempt to move and hold above the previous day's high, and it actually takes some time, but after this weakness on this second attempt here, we see that price came back up and tested. You see this base of support, tested the base of support before initiating a more rapid move downwards. What's interesting about this is you see how deep this retracement was. For price to move from the depths of this retracement and trade above the previous day's high and hold will require a lot more commitment from traders to the new price levels, and there must be enough stimuli in the market, whether it be news or anticipation of news or events or data that's coming out, and the market must feel strongly enough about that anticipated data in order to feel comfortable moving price above the previous day's high and holding. Look how much it already rallied the previous day. This is on my Fibonacci Trader charts. Tell them Chris Laurie sent you. But this is what it looks like. We see here we've got a nicely established low here. Price comes all the way back down. It makes an attempt at the low, and it makes an attempt at the low while we're in the buy zone, right? So we have these two factors. Then sellers give way and flows pick up for the buying. Trading pretty well anywhere in here. Any of this hesitance to for the sellers to make lower lows and hold below, you can pretty well buy anywhere in here, or you can wait for confirmation using your tools. And this is really you can pretty well trade anywhere in here. I would be confident trading, but the more price rallies, the further away your stop gets, because you want your stop to hold below this low. This is the way on this software. This is the Sunday, and what happens is we have so little data on the Sunday that it has very narrow pivot reference points on the Monday, which are effectively useless, right? And then again, they spread themselves and kick in a logical manner on the following day, on the Tuesday. So I just wanted to point that out because we'll see that from time to time as we work through these slides. Here, price opens at S1, and this is M2 here, but we have a nice tweezer bottom, doji, before price moves up for the day. When looking for a trade using pivot points, once again, we're looking to buy in the buy zone, sell in the sell zone. When you see a confirmation of a top or bottom, using your pivots, bring in your other additional tools, but you should actually have a full spectrum of your analytical tools when analyzing these trades anyway. But we will look at some refining our entry levels, and that's going to be one of the most valuable sections in the course when we do that. Right? When we see a base forming and we want to buy, we can wait for confirmation, or we can buy into the base. The longer you wait to buy, the lower the probability is associated with that move, and the further away your stop will be. Be sure to take profit before your key levels, your central pivot, your M3, your R1 in this case. Again, here we see a test of the lows. Price breaks through this trend line. You can buy it here if you want. Try taking some profit before the central pivot. If there's not enough room, then you'll have to wait until price gets through to M3 or to R1. Just reinforcing the sell zone. Price enters into the sell zone if we see a distinct top forming at a key level established by our pivots and other tools. We can wait for a trend line break or a retest, but be sure to take profit before the central pivot, M2 or S1. Visually now, once again, we see an attempt to move above the previous day's high. We see price weakness here with these candlestick formations, price weakness, further weakness here as price is failing to make an attempt to get above the previous day's high and the current high. You can sell it on confirmation, or you can sell it up here. I prefer to try to sell it up here, and we'll learn how and why to do that in the coming sessions. But be sure to take profit before your central pivot. We also have what's called an M1 or M2 day. 76 pips is a good general number to use for the euro range on a daily basis. So you should have a range of 76 pips available for you in order to make some profits. We're going to look more at true range later, as this number can change. It can become very dynamic and change daily with the market. But typically, if the just to give you a bit of a definition of an M1, M3 day, in general, if the previous trading day closes lower than the open, or if it was a down day in the previous day, then the current day we can look for the market to trade between M1 and M3, typically in that range. Or it could be S2 in the central pivot, or S1 and R1, but we will commonly see it trade in a lower range. The same applies to an M2, M4 day. In general, if the previous trading day closes higher than the open. Or if it was an up day overall, then we look for the market in the current day to trade at a higher range for the current day of trading. And the higher range may be M2, M4, so ranging between the support and resistance of M2 or M2 and M4 levels, or it could be the central pivot point in R2 or S1 and R1, for example. Considerations when trading pivots. The larger time frames have more power. Keep that in mind, and you can apply your weekly and monthly pivots points as well to the larger time frames. Every winner looks like the last loser at some point when trading. If you decide on a trade, trade into price action, moving against the direction of your trade to reduce your loss exposure. And we're going to cover that in the ideal trade entry section. It is higher probability to trade MACD divergence when price action is at an extreme overbought or oversold scenario. MACD divergence is higher probability following smooth price action. It is preferred if MACD divergence is at the end of a run, and also if you're in a buy or sell zone, deep into a buy or sell zone with your central pivots. It's preferred if MACD divergence occurs at a key level on failure at resistance or base of support. And now we're bringing in these other factors now, the MACD, just to give you a bit of a larger spectrum. But again, we're going to be covering these in more detail with our simulated scenarios as we incorporate all of the tools. When we see a candlestick, the body of the candlestick is where the primary price interest point was for that time period. Often the wicks can be errant price action. There is typically less liquidity when the wicks are formed on the candle. Ultimately, you have to trust in your tools and your understanding of the market. And again, I want to reinforce that understanding the market is the most valuable tool that you will have to be profitable in this market. If you ever decide to enter a trade and you're indecisive or you're confused, you'll probably lose on the trade. Trading is 5% satisfaction and 95% discernment and concern about what is happening in the market and analysis. This means that 95% of your mental energy is being consumed by the analysis and the management of the trade, and the end result will take care of itself if you manage your trades effectively.